Hi friends, welcome to Adda 24/7. We are in the Scholars series for BFM, and here we are covering all the important theory, numericals, objective questions and case studies. So watch the series till the end and also watch the complete series. Okay, let's start. First question, quite big one, huh? It's a biggie. We call it biggie, right? So quite a big one. Which of the following is not correct statement regarding sensitivity in context of the market risk measurement? So this is a quite big question. Huh? Yeah, everyone focus clearly on this. Which of the following is not a correct statement regarding sensitivity in context of market risk measurement? Now look at this, sensitivity and market risk. Okay, what is sensitivity? Sensitivity is a measure of market risk. Okay, market risk is measured in two forms. One is the sensitivity. Okay, sensitivity, and second is duration approach. Again, paid classes. In paid classes, I do take the in details all these parts. Okay, so now we are studying over here sensitivity question. Got it? Sensitivity is measured as change in the market value due to the unit change in the variable. Unit change in the variable. So sensitivity is measured as change in the market value due to the unit change in the variable. Due to unit change. Unit change in the variable means what? 1% change in the repo rate, let's say. That is known as unit change in the variable. So change in the market value means market price of that bond. Okay, always remember one thing. I'll give you one simple logic. Okay, the price of the bond, price. Okay, let me see how many of you know this. Price of the bond and interest rates, or let's say repo rate, they are related how? Suppose if let's say the repo rate goes up, then what happens to the price of the bond? In the comment section, type fast. If repo rate goes up, what happens to the price of the bond? Up or down? It generally goes down. Okay, it's in the reverse proportion. Always remember. Okay, that's why change in the market value means price based on the change in the value of the variable means repo rate. Okay, sensitivity as a measure suffers from the fact that it does not consider impact of other parameters which may also change simultaneously. Now we want not correct. Look at this. The question is, always keep in mind the main question, not correct. Okay, so sensitivity suffers from the fact that it does not consider impact of other parameters which may also change simultaneously. What are the other parameters? Now look at this. Repo rate and price change, right? These are, repo rate is one parameter, but what are the other parameters? Other parameters means it can be inflation, that can also be part. It can be the forex reserves, that can also be the part. Okay, so these are other parameters. C. Sensitivity as a measure suffers from the fact that it does not remain constant for all the values of the variable. It does not remain constant for all the values means what? What do you mean by this? Here, let's focus on the values. Just now what did I tell you? One is repo, second is inflation. Okay, third one is, let's say, forex reserves with RBI. So let's say these are the three parameters. So the price change of the bond, will it be the same for all the parameters? Repo changes by 1%, price changes by 2%. Inflation changes by 1%, price changes by 2%. Forex changes, reserves change by 1%, price changes by 2%. Will it happen like this? Type in the comment section yes or no. Repo changes by 1%, price will also change by 2%. Inflation changes by 1%, price will change by 2%. Again same, see this, here I am keeping this same constant 2%. Forex changes by 1%, price changes by 2%. Will it happen like this? It will not, right? So which one of them is not correct? Now think over it. Which one of them is not correct? We want not correct. Or is it the last one? Right? So which one of them is not correct? None of the above. Think. Is A not correct? B not correct? C not correct? Okay, let's think about A. Measured as a change in the market value due to the unit change in the variable. So that is true. But unit change in the repo rate will make the price change in the bond. Okay, so that is true. Sensitivity as a measure suffers from the fact that it does not consider the impact of other parameters which may also change simultaneously. Means what? It means over here when I am studying repo versus price, okay, I am just considering the correlation between these two parameters. I am not considering inflation and forex changes in this. So this is also true. This is also true. Whenever we study any parameter for the result, we have to study only that parameter. Sensitivity as a measure suffers from the fact that it does not remain constant for all the values. This is also true. So what is the false one? Not correct. D. None of the above is the correct one. So which of them is not correct? None of the above. Because all of them are correct. Got it? Watch the question again. Everyone kindly watch the question again. Very important one. Very difficult one. The change in value of 0.01% change in the market yield is called as. Now this is simple. I'll move fast on this. Basis point change, percentage change, duration, and price volatility. Fast. Give me the answer fast. 0.01%. Okay, means 1/100th part of the percent. So it is called as basis point. Okay, basis point. Remember this. It's called as basis point. There are two approaches. One is basis point, and second is duration, modified duration. Okay. So duration is for 1%. Remember this. I'll give you gross level, means big level. 1% change is duration approach, and 0.01% change is BPV, basis point valuation. Okay. On average, the equivalent time which the holder of a bond must wait to receive the present value of the cash flow is called as what? Oh, on average equivalent time which the holder of the bond must wait means, suppose if I'm holding a bond, what is the average time for which I must hold this bond to receive the present value is known as what? Downside potential, duration, basis point value, and value at risk. So many difficult words are given, right? So many. Let me see how many of you can answer this. How many of you are answering this? Let me see. Comment section fast. Okay, it is. Some of you are answering downside potential, right? Answer is simple. See here, always in my many of the lectures I do tell answers are simple. So the answer is duration. Okay, the duration means what? Which duration are we talking of? Again, remember there are two durations. What are the two durations? Two durations. What are the two durations? Number one is Macaulay duration, Macaulay, right? Macaulay. And second one is modified, right? Modified duration, right? So these are the two durations. Here we are talking of Macaulay duration. Modified duration we have talked in the earlier question. See this. Here I gave you this duration of 1%. This is modified duration, modified. Okay. And here we are talking of Macaulay duration. Got it? Macaulay. Got it? What is Macaulay duration? Macaulay duration is a duration in which, in the life of that bond, in which, okay, in which what? The interest rate risk is zeroized. Interest rate risk equals to 0. This is a main point about Macaulay duration. Okay, interest rate risk is 0 in this. Okay, so this is known as duration. Remaining all things are totally different. Value at risk means what? what is the amount, or what is the this amount at risk. Suppose, let's say, I'll explain you what is value at risk. Okay, let's say I buy a Reliance share. Okay, now let's say I've invested 2900. Let's say one share is what, at 3000. Let's make it 3000 round. Reliance share is at 3000 approximately. So if I invest 3000, is my entire 3000 amount at risk? What is the recent trend of Reliance share? So look at this. Suppose if this is a line of 3000 and the share moves between 2800 to 3200, means daily it moves between this to this. Lower side it goes to 2800 and upper side it goes to 3200. So what is my VAR, that value at risk? Value at risk means whatever is a fluctuation. This complete fluctuation is known as my VAR, 400. So even though I have invested 3000 rupees in the Reliance share, it doesn't mean my entire 3000 amount is at risk. My only 400 rupees is at risk. Okay, so this is known as VAR. Remaining things already explained. BP we explained. Downside potential we have explained it earlier in one of the earlier lectures. Kindly follow that. Okay. The longer the duration of a security, longer the duration means what? Bond having the maturity period of long time. Okay. Or once the bond life is longer, the Macaulay duration also becomes longer. Which of them is correct? Now we want the correct one. Huh? Longer the duration of the bond, the shorter will be the price sensitivity yield charge, and higher would be the risk associated with the bond. Think over it. Huh? Everyone think over it. Shorter will be the price sensitivity. Next, greater will be the price sensitivity yield charge, and higher would be the risk associated with the bond. So higher risk, longer duration, higher risk. Okay, longer, higher risk, higher. The greater will be the price sensitivity yield charge, and lower would be the risk associated. Greater is the price sensitivity greater, and last one, shorter is the price sensitivity yield and lower is the risk associated. Now think over it. Apply your own logic everywhere, because this question should be based on your logic as well as your studies. Think over it. Greater will be the price sensitivity. Greater is the price sensitivity. Okay. And higher would be the risk. Shorter is the price sensitivity and higher is the risk. Greater is the price sensitivity and lower is the risk. Okay. Shorter is the price sensitivity and lower is the risk. So what should be the correct answer? Look at this short, high, this concept. Shall I give you the answer? Let me see in the comment section. Very difficult one. This is a bit of difficult question. A bit mind tickling, you can call it. Okay. So let's see. Okay, let me explain you some part. Duration is longer. What do you mean by duration is longer? Duration is longer means what? The time horizon is longer. See here, one bond is of the period of 3 years. 3 years. And other bond is of the period of, let's say, 10 years. 10 years. So which bond will have higher sensitivity or higher movement? Which bond will have higher sensitivity with respect to change in the base, any base this element or base parameter? So whichever bond has longer duration will have greater sensitivity. This will move faster. This will move slower with respect to one parameter. Sensitivity means movement. Okay, here it will be higher. So greater is the price sensitivity. So that is okay. Now the answer is either B or C. Okay. And now higher would be the risk associated with the bond and lower would be the risk associated with the bond. Now this is a case. if a bond is of longer duration or if the bond is of shorter duration, who will have the higher risk? Okay. If I ask you to invest in something which will give you returns in 2 years, and then I ask you to invest something which will give you returns in 20 years, which one will you prefer? 2 years or 20 years? Write in the comment section. If I ask you to invest in something which will give you returns in 2 years, whereas I'll ask you to invest the same amount in something which will give you returns in 20 years, you will definitely invest in 2 years. Why? Because you say 20 years, who has seen? What happens in 20 years we don't know, because there is the element of risk associated with it. Whenever any bond or any instrument has a longer duration, the risk associated will always be higher. So the answer over here is B. Greater the price sensitivity and higher would be the risk associated with the bond. Okay? Got it? Simple, clear? Move on. Bond price changes can be estimated using the modified duration with a formula. So what is the modified duration formula now? So duration into modified duration into interest rate changes. Modified duration into interest rate changes. Minus modified duration into yield change. Modified duration upon yield change. So what is the answer now? Yeah. Bond price change. We are calling it bond price change. Remember, the first question in today's series, what did I tell you? There was a major hint given to you about this question. In first question, go back, pause this video, go back. There was a major hint given. Why? What was that hint? The price of the bond and the interest rates move in which direction? Same direction or opposite? This was a hint. So when I am saying that it is an opposite direction, it means the answer will be minus. Opposite means minus. So the answer is C over here. Okay. So the bond price changes can be estimated using the modified duration with the following formulae. Minus modified duration into yield change. This is the answer. That's why I gave you the hint. What was that first question or the initial question? Okay. What was that question? It was minus bond price and the yield are always in opposite direction, right? To calculate the value at risk, there are following approaches. Number one, correlation method, also called as variance or covariance matrix method. Historical simulation, Monte Carlo simulation, and Macaulay's duration. So value at risk. Value at risk means, just now I gave you that example of Reliance. 3,000 invested, 200 up, 200 down. So value at risk is 400. So what is the answer for this? Yeah. How to find out the value at risk? What are the methods? Value at risk methods. Correlation method, historical simulation method, and Monte Carlo method, and Macaulay duration. So value at risk is determined using which of the methods? 1 to 4 all, 1 to 3 only, 2 and 3 only, 1 and 4 only. Now think. Yeah. Think over it, everyone. Think over it. It is B, 1 to 3 only. Macaulay's duration is not considered in value at risk. Okay. For calculating VAR, we don't consider Macaulay duration, correlation, historical simulation, and Monte Carlo. Okay. To calculate the value at risk, the various approaches are based on the following parameters. Now look at this. Various approaches means what? These are the approaches. These: correlation, historical, and Monte Carlo. But what are the parameters? What are the parameters? Holding period, historical time zone. Holding period, confidence interval. Historical time zone, time horizon, and confidence interval. Holding period, historical time zone, and confidence interval. So all of them. So which of them is the answer? Second, this one. Yeah, think over it. It is everyone, fast. It is D. Correct. Holding period, historical time zone, and this confidence interval. All the three are required. Okay, to calculate all the three approaches over here. These three approaches: correlation, historical, and Monte Carlo. All are based on these three parameters: holding period, historical time horizon, and confidence interval. Okay. So that was a YT series. Now before going, let me show you. Kindly join the batches. Okay. Kindly join the here. What is happening is the exams are coming near now, right? So do join the batches ASAP. Which are the batches? Let me show you. Hold on. Friends, welcome to the Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. It is, which is the wrong one? Wrong one is this. The last country to join ACU is Myanmar. Myanmar with effect from 2010. Myanmar is not the last country. Okay, Myanmar has joined long back in 2003, 4 almost 2, 3, 4. At that time. Remaining all are correct. There are 9 countries in ACU. Okay, settlement takes place through ACU dollar or ACU euro. Both of them are there. Separate dollar or euro account is to be maintained. So we need to have a separate ACU dollar account or ACU euro account with the banks which we deal in within these countries, these 9 countries. Okay. Now there are these 9 countries. I can tell you some names: India, Pakistan, Burma, then what? Myanmar, Nepal, Iran, 6, and there might be 3 more. Okay. So these all 9 countries form together the ACU unit. Okay. Export declaration form is not required to be submitted by the exporter if the value of the export consignment is. So EDF is not required to be submitted if the value of the export which is to be made is up to USD 1 lakh, up to USD 50,000, up to USD 25,000, and up to USD 10,000. Think over it now, everyone. Yeah, the answer is yes, everyone. 25,000, right? USD 25,000. So EDF is not required to be submitted if the value of the exports is up to USD 25,000. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel right now, because in this channel you will be getting the latest updates of from IIBF. Number 1, number 2, free YouTube series on all the subjects of your JIB and CIB plus other bank promotion exams. So click on that bell icon, subscribe to it immediately. Okay. Form ETX is used by. So ETX, where is it used? AD when they extend the time period of pre-shipment loans. AD when the post-shipment loan is written off. Exporter while seeking the extension of time for realization of export bill. Exporter for seeking extension of time for extending the period of pre-shipment loan. Now, what can be the answer of this? When they extend the time period of pre-shipment loans or written off or extension of time for export bill or pre-shipment loan. Think over it. How many of you have started the studies? Tell me. Sincerely tell me. How many of you have started the studies? Type in the comment section if you have started the studies. Give me the answers also in the comments only. If you have started the studies, tell me. Have you started the studies? Everyone? Type yes. Yeah. So the answer is over here. What is the answer? Think. Is it pre-shipment? Is it written off? Is it extension of time? Is it that pre-shipment loan, extension for pre-shipment loan? Think over it. This is a difficult one. That's why you'll have to think more. The answer is ETX form. See this. ETX full form is extension form. Extension. Actually, it should have been EXT, but they call it ETX. Extension. The extension is always received for realization of export bill. Whenever your export bill is not realized within the time, now what is the time period? It is generally, earlier it was 12 months. Now because of that COVID, RBI started 15 months. Okay. So if your bill is not realized within 15 months, then you'll have to submit the ETX form to RBI through the AD, means through the bank. Okay. The credit directly extended by the overseas supplier to the of goods to the importer is called as. I told you I'll be discussing this supplies credit when the subject topic comes. Okay. So now think over it. What did I tell you? I'll be discussing the supplies credit when the topic comes. So now the topic has come. See this. What did we discuss earlier in buyer's credit? This was a buyer. Buyer was from India, right? Buyer was from India. He arranged for the credit from USA. Some bank he arranged. Bank. Okay. Bank. So bank gave him the loan. Okay. And then what did he do? By getting this loan, suppose loan was received from this bank in USA. So this loan is received by this buyer, and this buyer paid the supplier immediately. This buyer paid the supplier right now, immediately, today only. Okay. This was paid immediately. Okay. Now the difference between supplier's credit and buyer's credit is, here this bank is not giving the loan. So this is not there. Only this part is there. So here what will happen? This immediately will not be there. So this supplier will be supplying to this buyer with a credit period. Credit period means the supplier will be supplying for, let's say, 2 months, 3 months duration. Means I'll give you the goods now. You pay me after 2 months. So whenever any goods are sold on credit, on udhari, then that is called as what? Credit directly extended by the overseas supplier. So that is called as buyer, supplier, trade and ECB. Answer is simple. ECB, supplier's credit, right? Again remember, buyers and suppliers are the part of trade credit only. Okay, remember this. Got it? Next one. No person in India can import or export unless she has obtained the following: import export code number from DGFT, authorization for DGFT from DGFT, authorization from RBI, import export code number from RBI. Now this is a simple JIB question. Okay, let me see how many of you can answer this. Got the answer? So it is import export code from DGFT. This IC code is required by each and every person who wants to import or export in India or from India. Okay, compulsory. The supplier's credit extended by the overseas supplier for a period of more than 3 years is termed as. Again confusion in this. Here options are the same again: buyer's credit, supplier's credit, trade credit and ECB, external commercial borrowings. What is it called as? Just now when I discussed a buyer's credit, I told you something. What was that? Think over it. Again, rewind this video. Go back. So, I told you that it is ECB, external commercial borrowing. Whenever any loan is beyond 3 years, it is called as ECB. See here, it's simple. Okay. Below 3 years, less than 3 years, and 3 years and above. What? 3 years over here. Okay. So it is ECB over here, ECB. And this is trade credit, trade. Now this trade credit is of two types: buyer's credit and supplier's credit. Okay, this is a basic classification between all these. So the answer over here is D, ECB, external commercial borrowing. Okay. The decrease in value, foreign value of the foreign exchange rate, which is done during the market due to the market forces, is called as what? So decrease in value of the this foreign exchange, which is done due to the market forces, is called as what? Think over it. What will be called as? Now look at the options: appreciation, depreciation, devaluation and revaluation. Quite simple to answer. Think over it. Think over it. What is the answer? Got it? You'll get confused over here. Decrease in value. Decrease in value means it is either depreciation or devaluation. Either depreciation or devaluation. Now the confusion is between these two only. Is it depreciation or is it devaluation? Now look at this. Foreign exchange due to the market forces. Market forces. Okay. Now this is a trick. This will separate this depreciation from devaluation. So think about this. I'll explain this. I'll give you the explanation also. Not to worry. It is, see here, whenever market forces do anything, it is called as depreciation. Market forces. Okay, I'll mark this over here. Market forces. And devaluation is done when? Then I think so there's a next question. Let's see. Is it there? Let me see if the question is there. No. So now I'll answer here only. Okay. So if it is done due to the government pressure, government interference, okay. If it is done by the government, in that case it is called as devaluation. Market forces, it is called as appreciation and depreciation. If the price increases, then it's appreciation. If it decreases, then it's depreciation. Okay. Got it? Simple. Next one. Which of the following is not the correct value of the domestic currency? Not the correct value. Okay, which of the following is not the correct value? Correct in value, not value. Correct in value of the domestic currency. Devaluation is done by the government. Just now I told you. Revaluation is done by the market fluctuations. Appreciation is caused by the change in demand and supply. And none of the above. Not correct. Think over it again. Okay. What do you mean by not correct? Not correct. Okay. Devaluation is done by the government. Okay. So is this correct? What did I tell you just now? Appreciation, depreciation is done by the market forces. Devaluation and revaluation is done by the government. So this is correct. So this is true. But I want false. So this is not the right answer for me. Revaluation is done by the market fluctuations. This is the catch. Okay. So this is false. Right. Appreciation is caused due to the change in the demand and supply. So demand and supply, that is appreciation, depreciation. So that is true. So we want not correct. Not correct is this. B is the answer. Revaluation and devaluation are done by the government. They are not done by the market forces. Okay. Market forces do appreciation and depreciation. Okay. Again, everyone, subscribe to Officers Adda 24/7 YouTube channel. Also download the this Adda 24/7 app on your mobile. Both the things you should do it now. Okay. Which of the following is correct? Devaluation in value of the domestic currency is caused due to the fluctuations in the demand and supply. Devaluation in the value of the domestic currency is done intentionally by the government. Appreciation is done intentionally by the government. Both A and B. Yeah. What do you think? I am watching you. What should be the answer? Think over it. In the comment section. Give it in the comment section, everyone. Yeah. What is the answer? Yes, everyone. Devaluation in the value of the domestic currency is caused because of fluctuations. Devaluation is done by the government. Revaluation is done by the government. So this is false, right? So this is false. Devaluation in the value of the domestic currency is done intentionally by the government. Done. True. So one, I got it true over here. Appreciation is done intentionally by the government. Appreciation is done by the market forces. So this is false. Both A and B, that is obviously false. Okay, so the answer is B, only B. Okay, which of the following is correct? Only B, Only B is correct. Got it, everyone? Hi friends, welcome to the Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. Okay, so first question: the credit arranged by the buyer, importer, from a bank or financial institution outside India to settle the payment of imports is called as. Now understand this question properly. The credit arranged by the buyer from a bank, okay, outside India. So buyer from a bank outside India means what? This buyer is from India. Understand this properly. These are important points. Okay, this buyer is from India. Buyer. Okay, and now this buyer is arranging for credit from some bank in foreign. Let's say USA. USA. Let's say Citibank. Okay, Citibank. So this buyer is arranging for credit. So loan is given by Citibank to this buyer in India. This buyer contacts the Citibank and gets the loan. So this is called as what? Outside to pay the settlement of imports is called as what? Means this buyer has to pay for imports. For that he is getting a loan. The loan can be got through two ways. One through India or through outside. If he gets through India, then it's a simple loan. If he gets through foreign bank, then it's called as what? Buyer's credit, supplier's credit, trade credit, or ECB. Think over it, everyone. Answer it properly. After thinking properly, answer it. You'll get confused in two parts, I'll tell you. What are those? Okay, I'll give you the hint in this. Answer is between A and D. A and D. Now you think over it. Yeah, it is. Here the answer is called as buyer's credit. Remember this. Buyer's credit it is called as. ECB is also a part, means buyer's credit is a part of ECB, external commercial borrowing. But external commercial borrowing is above $20 million and it is about 3 years. Any loan taken from other banks outside India, okay, within 3 years and within 20 million by this buyer or any person is termed under buyer's credit. Okay, what is supplier's credit? I'll come to that later when the question comes. Okay, trade credit means what? This trade credit is a, here understand the concept again. Here trade credit consists of two parts. It consists of two parts. Okay, one is buyer's credit BC and second is supplier's credit. Okay, so the whole term is known as trade credit. So whenever the buyer arranges for this credit, it is known as buyer's credit specifically. Which of the following is not correct regarding Asian Currency Union settlements? ACU settlements. Now what are ACU? ACU are the 9 countries in Asia which have formed something called as ACU dollar. Now ACU dollar is not a separate dollar. It is the same dollar, but it is done as a netting effect. Means, for example, if India sells to, let's say Myanmar, okay, Myanmar, okay, Myanmar. If India sells to Myanmar, okay, and Myanmar also sells something to India. India sells to Myanmar and Myanmar sells to India, both. India sells, let's say, $100 and Myanmar sells, let's say, $40. So the difference is called as $60, which is positive for India. That is known as ACU dollar. That is reported to the USA. That is known as ACU dollar. So ACU dollar is not different. ACU dollar is a netting effect. Okay. So which of the following is not correct? Now we want not correct. Huh? There are 9 countries in ACU. The last country to join ACU is Myanmar with effect from 2010. Settlements takes place through ACU dollar or ACU euro. Separate dollar or euro account is required to be opened to distinguish the ACU. So which is this correct one? Again think. Yeah? It is. Which is the wrong one? Wrong one is this. The last country to join ACU is Myanmar. Myanmar with effect from 2010. Myanmar is not the last country. Okay. Myanmar has joined long back in 2003, 4 almost. 2, 3, 4 at that time. Remaining all are correct. There are 9 countries in ACU. Okay. Settlement takes place through ACU dollar or ACU euro. Both of them are there. Separate dollar or euro account is to be maintained. So we need to have a separate ACU dollar account or ACU euro account with the banks which we deal in within these countries, these 9 countries. Okay. Now there are these 9 countries. I can tell you some names: India, Pakistan, Burma, then what? Myanmar, Nepal, Iran, 6, and there might be 3 more. Okay. So these all 9 countries form together the ACU unit. Okay. Export declaration form is not required to be submitted by the exporter if the value of the export consignment is. So EDF is not required to be submitted if the value of the export which is to be made is up to USD 1 lakh, up to USD 50,000, up to USD 25,000, and up to USD 10,000. Think over it now, everyone. Yeah, the answer is yes, everyone. 25,000, right? USD 25,000. So EDF is not required to be submitted if the value of the exports is up to USD 25,000. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel right now, because in this channel you will be getting the latest updates of from IIBF. Number 1, number 2, free YouTube series on all the subjects of your JIB and CIB plus other bank promotion exams. So click on that bell icon, subscribe to it immediately. Okay. Form ETX is used by. So ETX, where is it used? AD when they extend the time period of pre-shipment loans. AD when the post-shipment loan is written off. Exporter while seeking the extension of time for realization of export bill. Exporter for seeking extension of time for extending the period of pre-shipment loan. Now, what can be the answer of this? When they extend the time period of pre-shipment loans, or written off, or extension of time for export bill, or pre-shipment loan. Think over it. How many of you have started the studies? Tell me. Sincerely tell me. How many of you have started the studies? Type in the comment section if you have started the studies. Give me the answers also in the comments only. If you have started the studies, tell me. Have you started the studies? Everyone? Type yes. Yeah. So the answer is over here. What is the answer? Think. Is it pre-shipment? Is it written off? Is it extension of time? Is it that pre-shipment loan, extension for pre-shipment loan? Think over it. This is a difficult one. That's why you'll have to think more. The answer is ETX form. See this. ETX full form is extension form. Extension. Actually, it should have been EXT, but they call it ETX. Extension. The extension is always received for realization of export bill. Whenever your export bill is not realized within the time, now what is the time period? It is generally, earlier it was 12 months. Now because of that COVID, RBI started 15 months. Okay. So if your bill is not realized within 15 months, then you'll have to submit the ETX form to RBI through the AD, means through the bank. Okay. The credit directly extended by the overseas supplier to the of goods to the importer is called as. I told you I'll be discussing this supplies credit when the subject topic comes. Okay. So now think over it. What did I tell you? I'll be discussing the supplies credit when the topic comes. So now the topic has come. See this. What did we discuss earlier in buyer's credit? This was a buyer. Buyer was from India, right? Buyer was from India. He arranged for the credit from USA. Some bank he arranged. Bank. Okay. Bank. So bank gave him the loan. Okay. And then what did he do? By getting this loan, suppose loan was received from this bank in USA. So this loan is received by this buyer, and this buyer paid the supplier immediately. This buyer paid the supplier right now, immediately, today only. Okay. This was paid immediately. Okay. Now the difference between supplier's credit and buyer's credit is, here this bank is not giving the loan. So this is not there. Only this part is there. So here what will happen? This immediately will not be there. So this supplier will be supplying to this buyer with a credit period. Credit period means the supplier will be supplying for, let's say, 2 months, 3 months duration. Means I'll give you the goods now. You pay me after 2 months. So whenever any goods are sold on credit, on udhari, then that is called as what? Credit directly extended by the overseas supplier. So that is called as buyer, supplier, trade and ECB. Answer is simple. ECB, supplier's credit, right? Again remember, buyers and suppliers are the part of trade credit only. Okay, remember this. Got it? Next one. No person in India can import or export unless she has obtained the following: import export code number from DGFT, authorization for DGFT from DGFT, authorization from RBI, import export code number from RBI. Now this is a simple JIB question. Okay, let me see how many of you can answer this. Got the answer? So it is import export code from DGFT. This IEC code is required by each and every person who wants to import or export in India or from India. Okay, compulsory. The supplier's credit extended by the overseas supplier for a period of more than 3 years is termed as. Again confusion in this. Here options are the same again. Buyer's credit, supplier's credit, trade credit and ECB, external commercial borrowings. What is it called as? Just now when I discussed a buyer's credit, I told you something. What was that? Think of it. Again, rewind this video. Go back. So, I told you that it is ECB, external commercial borrowing. Whenever any loan is beyond 3 years, it is called as ECB. See here, it's simple. Okay. Below 3 years, less than 3 years, and 3 years and above. What? 3 years over here. Okay. So it is ECB over here, ECB. And this is trade credit, trade. Now this trade credit is of two types, buyer's credit and supplier's credit. Okay, this is a basic classification between all these. So the answer over here is D, ECB, external commercial borrowing. Okay. The decrease in value, foreign value of the foreign exchange rate, which is done during the market due to the market forces, is called as what? So decrease in value of the this foreign exchange, which is done due to the market forces, is called as what? Think over it. What will be called as? Now look at the options. Appreciation, depreciation, devaluation and revaluation. Quite simple to answer. Think over it. Think over it. What is the answer? Got it? You'll get confused over here. Decrease in value. Decrease in value means it is either depreciation or devaluation. Either depreciation or devaluation. Now the confusion is between these two only. Is it depreciation or is it devaluation? Now look at this. Foreign exchange due to the market forces. Market forces. Okay. Now this is a trick. This will separate this depreciation from devaluation. So think about this. I'll explain this. I'll give you the explanation also. Not to worry. It is, see here, whenever market forces do anything, it is called as depreciation. Market forces. Okay, I'll mark this over here. Market forces. And devaluation is done when? Then I think so. There's a next question. Let's see. Is it there? Let me see if the question is there. No. So now I'll answer here only. Okay. So if it is done due to the government pressure, government interference, okay, if it is done by the government, in that case it is called as devaluation. Market forces, it is called as appreciation and depreciation. If the price increases, then it's appreciation. If it decreases, then it's depreciation. Okay, got it? Simple. Next one. Which of the following is not the correct value of the domestic currency? Not the correct value. Okay, which of the following is not the correct value? Correct in value, not value. Correct in value of the domestic currency. Devaluation is done by the government. Just now I told you. Revaluation is done by the market fluctuations. Appreciation is caused by the change in demand and supply. And none of the above. Not correct. Think over it. Think over it again. Okay. What do you mean by not correct? Not correct. Okay. Devaluation is done by the government. Okay. So is this correct? What did I tell you just now? Appreciation, depreciation is done by the market forces. Devaluation and revaluation is done by the government. So this is correct. So this is true. But I want false. So this is not the right answer for me. Revaluation is done by the market fluctuations. This is the catch. Okay. So this is false. Right. Appreciation is caused due to the change in the demand and supply. So demand and supply, that is appreciation, depreciation. So that is true. So we want not correct. Not correct is this. B is the answer. Revaluation and devaluation are done by the government. They are not done by the market forces. Okay. Market forces do appreciation and depreciation. Okay. Again, everyone, subscribe to Officers Adda 24/7 YouTube channel. Also, download the this Adda 24/7 app on your mobile. Both the things you should do it now. Okay. Which of the following is correct? Devaluation in value of the domestic currency is caused due to the fluctuations in the demand and supply. Devaluation in the value of the domestic currency is done intentionally by the government. Appreciation is done intentionally by the government. Both A and B. Yeah. What do you think? I'm watching you. What should be the answer? Think over it. In the comment section. Give it in the comment section, everyone. Yeah. What is the answer? Yes, everyone. Devaluation in the value of the domestic currency is caused because of fluctuations. Devaluation is done by the government. Revaluation is done by the government. So this is false, right? So this is false. Devaluation in the value of the domestic currency is done intentionally by the government. Done. True. So one, I got it true over here. Appreciation is done intentionally by the government. Appreciation is done by the market forces. So this is false. Both A and B, that is obviously false. Okay, so the answer is B, only B. Okay, which of the following is correct? Only B. Only B is correct. Got it, everyone? We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the series till the end. Okay, let's start. Your foreign correspondent bank is maintaining a Nostro Rupee account with your bank. It wants to fund his account by purchase of rupees 30 million against USD. Assuming the USD INR interbank rate as 75.2552650, what would be the rate quoted to the correspondent, ignoring the exchange margin? Calculate the amount of USD you would receive in your USD Nostro account if the deal is struck. Now look at this. This question has almost 3 to 4 various questions. 3 to 4. Okay, what are the various questions here? Firstly, understand the numerical, what it is. Your foreign correspondent is maintaining the Nostro rupee account with your bank. So let's say this is Citibank. Okay, Citibank USA. So this Citibank USA is maintaining a Nostro account with your bank. Let's say you are SBI. Okay. So Citibank is maintaining a Nostro account with your bank. Now type in the comment section, what will this account be called as in the books of Citibank? Means Citibank will call this account as what? Nostro or Vostro. Type that. Citibank will call this account because Citibank is maintaining a rupee account with SBI. Here it will maintain the rupee account only with the SBI. So this rupee account maintained by Citibank with SBI will be called as what? In the books of Citibank. Everyone fast. It will be called as, yes. In the books of Citibank, I'm asking. In the books of Citibank. So it will be called as Nostro. In books of Citibank, it will be called as Nostro account. And the same account in the books of SBI will be called as what? The same account in the books of SBI means here Citibank is maintaining account with SBI. So it is your account with us. So that account will be called as what? This will be called as Vostro in case of SBI. Remember, Nostro and Vostro are not different accounts. They are same accounts. Okay, same account. Only from whose angle are we looking at it? That's important. So here Citibank, this will call this account as Nostro and SBI will call this account as Vostro. That's why it said correspondent bank is maintaining Nostro rupee account with your bank. So you are calling this as Vostro. Now it wants to fund his account by purchase of rupees 30 million. Understand this properly. Purchase of rupees 30 million means what? Rupees is purchased. So what is going to Citibank here? Whenever you purchase a vegetable. So purchase of vegetable means vegetable goes to you. Now who is purchasing it? Citibank is purchasing. So rupee will go to Citibank. Citibank wants the rupees. So if Citibank wants the rupees, what will Citibank have? Here, it's in USA. So it will have what? Dollar. It will have dollar over here, dollar. So Citibank will give dollar and receive rupee. Logic is clear? Citibank will receive rupee and give dollar. Got it? Clear? Now, how much rupees does Citibank want? Citibank wants 30 million. 30 million. Okay? Here Citibank is requiring 30 million over here. Okay? What is 30 million? Understand that also. Million. What is 1 million here? US system is very simple. I'll tell you. Thousands. They have simple rule. 1,000. Then what? Million. Then what? Billion. Then what? Trillion. And then last one is zillion. But forget this zillion. So 1,000 means 3 zeros. 3 0. I'll just write it zeros over here. How many zeros? Okay. So zeros 3. Million means 6 zeros. Billion means 9 zeros. Trillion means 12 zeros. And zillion means 15 zeros. Okay. So you generally require up to this only. What? Billion only. This. Okay. So when I say 30 million, it means what? 6 zeros. So 30 and 6 zeros. 1, 2, 3. 1, 2, 3. So in Indian method, we will be calling it this, and this. Okay, it will be called as what? Lakh, 10 lakh, 3 crore. Yeah, 30 million. No, yeah, correct. 3 crore. So rupees 3 crores. Now understand this. What are you doing? See here, 30 rupees, 30 million is going out. So dollar is coming in. So if dollars are coming in, what will we do? Will we buy or sell? Now look at this important part. Whenever dollars come in, everyone understand this, huh? Whenever dollars, have I written it here? No. I'll just draw a line over here because my video is up to this part, right? So whenever dollars come in, whenever they come in, okay, in. So we'll always use the buy rate, buy. Okay. What is the buy rate? Now look at this rate. 75.25502650. So always remember, whenever you write the rate, whenever you take this right side, that is always known as the sell rate. and this side is always known as the buy rate. Okay, so here we'll be using the buy rate. Why? Because dollars are coming in. Now what is the rate given? The rate given is this 75.2550. We'll take it now, right? 2550. So now what do I want? Look at this very properly now. Very important part. Huh? So $1 equals to rupees 75.2550. This is the rate. So $1 equals to rupees 75.2550. Now what do you want? What do you have actually? You have rupees or dollars now. You have this rupees, 30 million. So rupees, I'll just write 30 million below the rupees. So 30 million over here. Okay, I'll just write M over here now. Million means 6 zeros. Understand this. Now what do I want then? What do I want? I want this rate. Dollar I want. What are the two questions? See this. The main two questions are calculate the rate. What rate would be quoted to this customer? Ignoring exchange margin. So there is no exchange margin over there. So that's why whatever rate has come, you will directly give him. What is the rate to be given to that customer? The rate to be given to that customer is this 75.2550. This is the rate which will be quoted to the customer because we don't have the margin. Whenever you deal with the margins also, then what you have to do, you have to either add or subtract the margin. If you do the sale transaction, you'll have to add the margin. If you do the buy transaction, you'll have to subtract the margin. But now, no margin is given. So no margin, I'll write it over here. No margin. No margin means what? Whatever rate is given, take that only. So this rate only I'll take now. Clear everyone? Type yes in the comment section if it is okay up till now. I'll take some water now. So is it okay now? Up to this part? Type in the comment section. Okay. Done? Chal. Now next. So what do I do now? 30 million. I want dollars. How do I do? Cross multiply this. So what will I do? 30 million divided by this rate 75.2550. 75.2550. This is the only rate now. Otherwise what happens? We'll go ahead. 75.2550. Correct. Okay. So 75.2550. 30 million upon 75.2550. So do it now. Everyone do it in the comment section. I want the answer. 1, 2, 3. 1, 2, 3. 6 zeros, right? Upon 75.2550. Now give me the answer. Everyone. Give me the answer. Everyone in the comment section. I'll also try by that time. 30. 1, 2, 3. 30 million divided by 75.2550. What is the answer you are getting? Let me see from your side. I've got the answer. What is the answer you are getting? Everyone. Fast in the comment section. Let me see. Yeah. In the comment section. Yes. 398,644. Correct. 398,644. Okay. 0.6. So this is what currency? Dollar or rupees? This is dollar. Okay. This will be dollars. So dollar 398,644. This much dollar will be getting. See, the question is over here. Calculate the amount of USD you will receive because dollars will be coming in. So you will receive these dollars. Okay. So you will be getting these many dollars. 398,644. And the rate quoted to this customer is this 75.2550. These are the two answers. Okay. In exam, they might ask you various questions on this. They'll ask you this question also. Whether this account is called as Nostro or Vostro. They'll ask you various questions on this. Means they'll be asking you 30 million means this exchange margin. If it is subtracted, means if there is an exchange margin, then what do we do for buy for sale? They can ask you various questions on this. Okay. So that's why, is this numerical clear to everyone? Is this numerical concept and the logic plus the calculations clear to everyone? Type yes in the comment section. Okay. I will move to the next one. Before going ahead, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you'll be getting the latest updates from IIBF on JIB and CIB. Number one means IIBF gives various notifications, various change in subject, change in timing, change in venue, change in this, that, many things. So all are immediately updated over here. Okay. Secondly, you get a free YouTube series. What is the free YouTube series? Right now you are watching the same free YouTube series, Sankalpa series. So similarly, you get it on all the subjects, all. So that's why subscribe to it right now. Click on the bell icon, share it with your friends, click on the like button. Okay. Move on. Messrs. BCD wants to remit JPY 100 million by TT value spot as payment of an import invoice. Given if USD INR rates are 75.2500, 2600 and USD JPY rate as 116.5060, margin of 0.15% is to be loaded on the exchange rate. Calculate the rate to be quoted and the rupee amount to be debited to the account of Messrs. BCD. Now understand the problem correctly. What the problem is. There is some customer called as BCD. Okay, BCD. This customer wants to remit JPY. Remit means what? This is BCD. This BCD wants to send JPY outside. Send. So JPY is going outside. JPY is written is like this. Yen. Okay. So we'll be writing only Y now. Okay, because all these things difficult. Okay. So JPY is written as like this. So BCD wants to send JPY. How many? So 100 million. 100 million. These many JPY this guy wants to send. Now if this BCD wants to send it, how will that person send it? That person will send it through your bank only. How will that person send it through your bank? The person will approach your bank and you will debit that customer's account. So look at this. If yen are to be sent out, does that customer have yen? No. That customer has rupees. That customer is having an account with you in rupees, right? Rupees account is there with you. P. With let's say SBI again. Let's say you are in SBI. Okay. So this customer is having the account in rupees with you. Okay. So what will you do? This customer wants to send this JPY over there. So you will SBI. You will send JPY over here. You will send it yen, right? But when you send yen to someone else on behalf of this customer, you will debit this BCD customer, right? You will be debiting this customer by rupees. By what amount? You will debit rupees to this customer. By what amount? That is the only question. So how will you do it? See here, firstly understand JPY is to be sent out. So remit means you are using the buy rate or sell rate. Tell me first. Buy or sell? Buy or sell rate? Everyone. It's a outside dollars or other currencies going out. Whenever other currency is going out, we will always be using sale rate. So here we are using sale rate, right? Here we are using sale rate. Got it? Sale rate we are using. So what is the sale rate now? Look at this. Import. Here it's a import invoice. So import means always dollars or other currencies going out. Okay. So what is the sale rate now? See here. Look at the sale rate. 75 point. Should I take 25 or 26? Everyone over here. Should I take 25 or 26? I'll be taking what? 26, correct? I'll be taking 26 here. Now what am I doing over here? Look at this. I want JPY. I want to send JPY. So I want the rate of JPY to rupees. So always what do I want? JPY to rupees. This is the rate I want. But do I have JPY to rupees rate? Look at this. USD to INR I am having. USD to JPY I am having. But I am not having JPY to rupees. So how will I do it? So the JPY to rupees will be using the chain rule now. Chain rule remembers everyone. Chain rule. You had it in your JIB also. You remember the chain rule? Chain rule means what? See, JPY to rupee I want. So what will I do? I'll bring in a currency in between. JPY to dollar into dollar to rupee. See this dollar can get cancelled. So again it becomes JPY to rupee. Same, right? So here I am bringing in dollar in between. Now do I have these rates? Check this. Let's check this. What am I having? This dollar to rupee. Look at this. Dollar to rupee. This I am having it. Why? USD to INR. See this. USD to INR. Dollar to rupee. I am having this. So this is what rate? 75 point. Give me 75.26 sale rate, right? Because I am selling it. Do I have JPY to dollar? Check this. I am having dollar to JPY. But I want what? JPY to dollar. So what will I do now? It's reverse, right? So what will I do? First thing which will I do is, I'll first take what? Let me first draw this line here. Otherwise what happens? It goes behind me. So what will I do? I'll have dollar to J. I'm having what rate? Let me see. We are having dollar to JPY. So what is the dollar to JPY rate which I am having? Dollar to J, I'll write it. Dollar to JPY rate is what? Which I am having it. 116.50 or 60? Everyone. 50 or 60? 116.50 or 60? What is it I am having? What should I take? I'll take 116.60. Sale rate I want. Sale. Okay. So if dollar to JPY I am having, and what do I want? I want JPY to dollar. See, this is what I am requiring. So if I reverse this, what is the rate I will be getting? So JPY to dollar will be, I'll reverse this also. So whenever nothing is below, it means it's 1. So I'll be using 1 upon 116.60. Right? So JPY to dollar is 1 upon 116.60. Now what do I want? I want JPY to INR. So both the rates I've got now. So now my JPY to INR rate will be, look at this. JPY to INR rate will be, what was that? JPY to dollar into dollar to rupees, right? Dollar to rupees, right? This is the rate, just now we saw it. So JPY to dollar rate is what? Equals to 1 upon, look at this, 116.60 into this dollar to rupee. Now dollar to rupee, just now we got it, 75.26, this one. Okay. So 75.26, do it. 75.26. So give the answer. Bring it in points, okay? 75.26 divided by 116.60. Divide it, everyone. Everyone, yeah? So I'm getting it as 0.645, right? 0.645. So 1 JPY. So what is this rate? JPY to INR, right? This is what I want. So what rate will you be quoting to that customer? Calculate the rate. Now, but see here, there is a margin also involved over here. And I'm doing an import sale transaction. So for sale, what do we do? Margin. Firstly, what is the margin rate? Margin equals to, what is the margin given? 0.15%? Yeah. 0.15% of this rate, of this 0.645. So what is the answer? Do this. 0.645 into 0.0015. 15% means 0.0015, right? So it is it's very less, isn't it? 0.00009 something, right? 96, very less. Okay. So what do I do with this margin? I'll add this or subtract this. I'm selling, right? Selling. So whenever I'm selling, I'll add this. So what is my rate now? So rate equals to 645 plus 0.00096. So give this rate, add this, it becomes what? 0.645, very smaller rate, okay, this much. This is my final rate. So what is the question asked? What rate? Calculate the rate to be quoted. So this is one question, rate to be quoted. And second is rupee amount to be debited. What is the rupee amount? So what is the rate over here? This is JPY to INR. So 1 JPY equals to what? 0.645 96 INR. But what do I want? Do I want INR or JPY? I want what? 100 million JPY. So I want 100 million over here. 100 million JPY. So I'll write this below JPY. Now what is the question mark? Question mark is over here. So what will I do? I'll cross multiply. So how many rupees will I be debiting to that customer? Rupees equals to 100 million into 0.64596. Multiply this. This will be around. Okay, let's do it here. It's very difficult. Means these calculations 1, 2, 3, 1, 2, 3, right? Into this, whatever this same rate over here. What is the rate over now? Now, how many? 1, 2, 3, 4, 5. Remove 5 zeros from here. So it will be 6. What this 100 million into this? So it will be 64596 and then 3 zeros from here, right? 3 zeros. 1, 2, 3. Yes, 1, 2. So it will be 64 million. This much amount I will be debiting to this customer in rupees. So this is the amount debited to the customer. If they ask you in million, it will be rupees 64.59 million. This much amount I will be debiting it to the customer. Okay. Difficult one. Not that simple case study. Case study is very difficult. Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM and here we are covering all the important theory, numericals and objective questions. Okay, watch the series till then. Very important numericals are covered over here and very important objective questions are covered over here. So watch the series till the end. Let's start. First one. Read this. To calculate the VAR, value at risk, there are following approaches. Firstly, before going to the question, what is VAR? What is VAR? Value at risk means VAR. Look at this, VAR. What do you mean by this in simple terms? Okay, I'll give you a simple example. Suppose if I have invested in, let's say, a Reliance share. Reliance. Imagine, let's say the price of Reliance is right now at, let's say 3000. Okay. Now what is my VAR? Is my VAR complete? Value at risk means what is my amount at risk? Is my amount at risk complete 3000? No. Suppose if this is the price of Reliance 3000. Okay. And this Reliance share is fluctuating per day, per week, depending on my this tenure or my period. Suppose in a week or let's say in a month. In a month, let's say Reliance is fluctuating 5%. Okay, so 5% here and 5% there. So it will be what 5%? It will be 1500 over here and 1500 over there. We are 5%. 5% into 3000. Okay, so it will be 1500 over here. It is 1500. So this is 1500. Okay, and this is 1500. This. Okay. 1500. So if it is fluctuating 1500 on both the sides in one month, let's say, then my VAR becomes what? My VAR becomes the total of this. The total is 3000. Okay, sorry, 3,500. Sorry, yeah, it becomes 300, right? Because the price was 3000. I took it for 30,000. Okay, so this will be 3,300. Okay, so 150 over here, 150 over here. So it will become 300. So my VAR becomes 300. So got it? What is VAR? The fluctuation which is happening in that stock is known as VAR. Now this example I gave you for Reliance, a stock. It can be a commodity, it can be a dollar, it can be a gold, anything. Okay. So to calculate the VAR, there are the following approaches. correlation method, also called as variance or covariance matrix method, historical simulation method, Monte Carlo simulation method, and Macaulay's duration. So the options are 1 to 4 all, B is 1 to 3 only, C is 2 and 3 only, and D is 1 and 4 or only 1 and 4. This is not 1 to 4. Okay. So what is the right option over here? Search in the Google. Have you read it? Anyone has read this? How to calculate the VAR? It's there in your module B. Okay, module B of your this BFM. So how to calculate? What is the method used? Everyone, let me see. What is the method used? It is 1 to 3 only. See here, it's not, Macaulay's duration is not used to calculate the value at risk. Macaulay's duration is used, Macaulay's duration is used to calculate that. What is Macaulay's duration? Macaulay's duration is that period of the bond in which the interest rate risk is zeroized. Interest rate risk equals to 0. Okay, that is the Macaulay's duration. Okay. To calculate the value at risk, the various approaches are based on the following basic parameters. So to calculate the VAR, what are the approaches that are based on the following parameters? So means all these approaches, or the three approaches which we saw over here. Okay. So they are based on what parameters? Holding period, historical time horizon, holding period, confidence interval, comma. Okay. Historical time horizon and confidence interval, holding period, historical time horizon and confidence interval, all the three. So what is the option? Correct option A, B, C or D? What do you say, guys? Think over it. Think of the answer. Think of the answer, everyone. Yeah. Is it 2, B or C? Is it B or C? See here, the correct answer over here is, okay, before that, before giving the correct answer, let me explain you. Value at risk. Okay. What are the parameters? So what do you mean by this word holding period? Holding period means for what time am I going to hold that bond? Means am I going to hold that bond for equals to holding, right? Second is what? Historical time horizon. Okay, let's look at this. What is historical time horizon? Historical time horizon means what is the duration for back testing I am considering. See, this back testing is an important parameter in your BFM. That's why I said join the batches as a back testing. Okay, because here everything is not able, I won't be able to explain everything. Back testing. Okay, so historical time horizon relates to that. Okay, historical, I'll just write the short form over here. Historical, oh, only historical, TH I'll write, time horizon. Okay, then confidence interval. What is confidence interval? See this confidence interval consists of 3 parts. Okay, in fact there are 3 parts. One is confidence level, then there is a mean, and then there is a variance. Okay, the 3 parts over there. So depending on that, the value of your bond changes. The confidence intervals are, you might have heard of these 3 confidence levels, intervals or levels also you can call it. 68%, 95% and 99.7%. Okay, so these 3 are the important parameters while calculating the value at risk. So what is the correct answer then? So the correct answer over here is D. Okay. The dash method for calculation of value at risk is deterministic approach. Dash method, see this. is a deterministic approach, correlation method, historical simulation, Monte Carlo simulation, and all of the above. Think over it. Deterministic. Firstly, what is deterministic? Deterministic means what? Deterministic means what? Deterministic means there is a relationship between the two parameters. That's the meaning of the word deterministic. Relationship between the two parameters. Okay? And the relationship between two parameters is done in which method? You might have studied this in your APM. In which methods we use this between two parameters? Do we use it in historical simulation? Do we use it in Monte Carlo, or do we use it in correlation? Answer fast in the comment section, everyone. Comment section. Dash method for calculation of value at risk is deterministic approach. Let me think. You should think, not me, isn't it? Yeah. What is the correct answer? Okay, the answer over here is, I'll explain you all. The answer over here is correlation method. Always remember that deterministic means comparison between two parameters. You should be able to get the exact answer. Two parameters comparison. Comparison. Okay? And exact answer. These are the 2 points about this. Exact. Okay? Historical simulation and Monte Carlo simulation are scenario analysis. These are known as scenario analysis. Monte Carlo is for scenario analysis. This is scenario. And historical simulation is related to SEER. Again, it's a simulation only. So these are simulation methods, and this is also related to back testing. But this correlation method is a deterministic, means here exact answer you will be getting. So correct answer is A over here. The historical simulation approach in the market risk calculates the change in the value of the position using. So this historical simulation approach in the market risk calculates the change in the value of the position. Means, what do you mean by this? See, this historical means, what did I give you? What did I give you? Give you, not give you. Okay. What did I give you? The historical simulation approach in the market risk calculates the change in the value of the position using the actual historical movements of the underlying assets starting from the current value of the asset. Projected historical movements from the underlying assets starting from the current value of the assets. Actual historical movements of the underlying assets starting from the future value of the assets. Sample of randomly generated price scenarios. Very confusing. Okay? Everyone think over it. Very confusing. Yeah? Think over it. I'll just wait over here. See this. I'll give you a few hints over here. Actual historical movements. Actual historical movements. Second is projected historical movements. I'll give you the hint over here. Actual historical, projected historical. And depending on the current value. So these are on current value. Okay? Current value, current value. Third, C1 is actual historical movements depending on the starting from the future value. Now you think over it. And last one, okay, sample of randomly generated price scenarios. Forget this. So the answer is between A and C. Think over it. A and C. What do you think should be the answer? Think over it logically also. Suppose if you don't know the answer, in exam it happens many times that you don't know the answer. So in that case, what will you do? First, you go on. You should go on this elimination method. Elimination means randomly generated. First, eliminate that. Nothing is randomly generated in statistics. Then projected historical movements. Projected. How can the historical movements be projected? Historical movements are actual movements where we have seen the actual thing. You can't project history, right? So B is also gone. Now A and C, actual historical movements based on the current value and actual historical movement based on the future value. How can I start from the future value? I don't know the future. So the correct answer over here becomes A. Okay, it will become A. A is the answer. Okay, next one. The Monte Carlo simulation method calculates the change in the value of the portfolio using the Monte Carlo simulation. This Monte Carlo simulation, what is this Monte Carlo? Firstly, understand this. Okay, I'll give you in one line. Actually, it is a deep session which I do take in the paid classes, but in one line I'll give you. Monte Carlo simulation means what? Here, it's a refinement scenario. Refinement. Refinement means what? Refinement. This is known as refinement scenario. What is refinement scenario? It means that suppose if I do the session today, means if I do a meeting today or think of any scenario today, okay, then my team will sit over here. My team of, let's say, 5 members sits over here, decides on various points. After it decides on various points, means that meeting comes up with 5 points. After these 5 points, we refine those 5 points, and next time when we discuss, again we'll be sitting. So there will be around 3-4 meetings or 3-4 refinements, we call it refinement. First refinement, then second refinement. Again these 5 members will sit, and when we sit for the next time, okay, we will discuss only those 5 points which we had come up in the earlier meeting. Okay, so only those 5 points. From here, what happens? We come up with, let's say, finalize on 2 points. So now we finalize on 2 points. Okay, I'll just write the points now. 2 points. Okay, one sec. So here there are, let's say, 10 points, 50 points. Okay, 50 points. From here we refine to 5 points. Second meeting. From second meeting we refine to 2 points. Okay, means we are going on refining the scenarios. What all can happen? So that is Monte Carlo simulation. And in the end, from the 2 points we come up to the single point, which is our main answer. So that is Monte Carlo. It goes on refinement. Means this I have given you in the layman's language. Okay. The Monte Carlo simulation method calculates the change in the value of the portfolio using actual historical movements of the underlying assets starting from the current value. Now see here, the answers are similar to that earlier one. Projected historical movements of the underlying assets using the current value of the assets. Actual historical movement of the underlying assets starting from the future value of the assets, and sample of randomly generated price scenarios. Answers seem to be similar. But the answers are different over here. Again go on refinement. Here we are talking of Monte Carlo simulation. Means here various points are considered. All the points, all the required points, all the required scenarios are considered. All the things which can happen in the world are considered over here. So what all things can happen? Can happen. See here, Monte Carlo simulation is can happen. Look at this. This is futuristic. Okay, futuristic. So can happen. Can happen. Now when I say can happen, then what happens? This history goes off. History is of no use to me. Okay. Now the answer can be only this: actual historical movements of the underlying assets starting from the future value of the assets, and sample of randomly generated price scenarios. Now the real fight is between C and D. Think of it. What can be the answer for C and D? What can be the answer? Either C or D. Think of it. Yes. What do you think? The correct answer is, think things here. Again apply the elimination method. Monte Carlo simulation means it can happen. Whatever things can happen in future. That is Monte Carlo. Okay. So whenever you think of future, firstly eliminate the history part. Now you can see the history part. You can look at this C, but there's the word of future. That's why I've kept it. Otherwise, C is also elimination. So the answer over here is C is also gone. So the answer will be D. Sample of randomly generated price scenarios. Remember, randomly generated, because what all Monte Carlo simulation is used for checking the future scenarios. These 50 points, 50 scenarios will be randomly generated. Out of these, various thinkings will be done, discussions will be done, and then we'll come up with, here I've given the example of 5. We can come up with 25 first. From 25 we can come to 5. From 5 we can come to 2. That's the way it goes. Okay. So the answer is D over here. In which of the following methods to calculate a change in the value of the portfolio, the user has not to make any explicit assumptions? Not to make, remember, not to make any assumptions. No assumption is required. No assumption is required means what? It means that directly whatever are the facts, use the same. Whatever are the facts, use the same. Think over it now. Answer is very easy in this, and it means I give you the hint also. Whatever are the facts, use them. So where are the facts? In which method are the facts? Correlation, historical simulation, Monte Carlo simulation, A and C both. Correlation and Monte Carlo, A and C both. Generally we have a tendency in exam, whenever we see this A and C both, or all of the above, or something A and B like this, so we tend to answer that A and C or A and B. Comment section. Give me in the comment section, everyone. Give it in the comment section. So it is. Many of you have the tendency of typing A and C. So the answer is not D. Remember, A and C both is not the answer. Either A, B or C. But now we are talking about only facts, no assumptions. So no assumptions is a part in history. In history, do you make any assumption? No, right? So B is historical simulation. This is the answer. In historical simulation, the user does not have to make any explicit assumptions. Okay? Which of the following is the usefulness of VAR? Means value at risk is used where? Why VAR is important? So, number 1, good tool for fund managers to for protection of customer businesses. Okay, good tools for fund managers to protect the customer businesses. So that is the first answer. Second one, think over it. What is the second one? Yeah. I'll make it a bit simpler. Okay. Think over it. By the time you read, what is the answer? Now give me the answer. A good tool for fund managers for protection of customer business translates portfolio exposures into potential profit and loss impact. A vital component of the current best practices in the risk management. Meets the external risk management disclosure and expectations. 1 to 4 all, 2, 3 and 4. 1 and 4 only, and 2 and 3 only. Okay, let's discuss these 4 options. Good tools for fund managers for protection of customer business. Is it a good tool? Value at risk. I gave you that example of value at risk. Reliance 3000, 5% fluctuation, 150 here or there, right? So total 300. So if I know the fluctuation of any stock or any commodity, will I be able to protect my or not protect, actually no, protection is not, will I be able to minimize my risk if I know the fluctuation? Yes, I can. So that's why my business funds will be protected. So A is the answer, 1 is the answer. right? So that's why this is the right answer. One. What about the second? Translates portfolio exposure into potential profit or loss impact. How much can be the profit? How much can be the loss by the fluctuation of that Reliance share by 5% here and there? Definitely that I can predict, right? Means how do the banks predict that this year our profits will be around this and this? How do the banks predict? Banks predict based on your VAR. Okay, a vital component of the current best practice in the risk management. So current best practice in the risk management. Remember, VAR is the best tool nowadays available for any banking calculation, any banking. Okay, so C is also the answer. Meets the external risk management disclosure and expectation. So this is the part. This is a important condition in the Basel norms. External risk. Basel norms consider systemic risk, very important. Systemic risk is an external risk, which is not because of you. It is basically the settlement risk. Okay, means a part, systemic risk is a part of your settlement risk. So it meets the external risk management disclosure and expectations, which are required by the Basel norms now. So the answer is all 1 to 4. Correct? 1 to 4. Remember, this external risk management disclosure is an important part in the Basel 3 now. Basel 3, remember. Basel 3, I'll write it. Basel 3 is an important term. 1, 2, 3, okay. Important term, and all the banks are now following Basel 3. Okay, those who don't know, we are all at Basel 3 now. So that's why I'll again tell you, join the paid classes. Okay, here we are covering all the important points. The process where the model based VAR is compared with the actual performance of the portfolio is known as back testing, stress testing, downside potential, and duration. Think about it. This I won't answer now. Let me see how many of you answer first. And answer is, I've given you the hints in this session only. The process where the model based VAR is compared with the actual performance. Actual performance. Okay. Where do you base it with the compare it with the actual performance? It is done in back testing. Again, back testing, we see here, what is back testing? Back testing means consider the scenarios for last 10 years. Means period can vary. I'll consider it for 10 years. Somebody can consider it for 5 years. Somebody can consider it for last 50 years. Okay? Like COVID. COVID didn't happen in last 100 years, but then it happened. Suppose if I compare, all the banks were comparing their portfolios for last 10 years before COVID. But what happened? One COVID year, last 10 years, I'll give you a simple method, okay? Last 10 years, the fluctuation in the markets was this way, somewhere like this. So last 10 years, there was not a major fluctuation, but COVID came, and what happened? This fluctuation went down like this. So suppose if I consider, if I would have been over here, okay, then I would have thought nothing can come like this. I'll just consider this much VAR. So my historical calculations or back testing was comparing this actual performance over last 10 years, these 10 years. Okay, but what happened? This is the example of stress testing, stress. This is the example of back testing, back means comparing your immediate future, immediate past somewhere. But stress means if something which has not come up in last 10 years, if that comes up, then what? That's the use of Monte Carlo simulation. Monte Carlo simulation is used to check various unseen scenarios. So the answer over here is actual performance of the portfolio. It is compared with this, so it is back testing. So back testing is used for limited purposes, for normal trading conditions. Normal trading. I can't use backtesting for the extreme trading conditions. Okay, we call it a tail theory. Okay, we can't use it for the extreme conditions. Okay, Which of the following is used to determine the possible changes in the market value of the portfolio that could arise due to non-normal movements? Non-normal. Normal means what? I just gave you that example. Backtesting, normal. Non-normal means backtesting, stress testing, downside potential and duration. Backtesting, stress testing, downside potential and duration. Remember, downside potential means what? Downside potential means what? Now here, you all guys will get confused between C and B. Okay? B and C will get confused. Non-normal movement. So where do I use this? In which method do I use this non-normal movement? It is this. So this stress testing, this is the non-normal movement of this like COVID. So this is checked in what? Strictly backtesting is not the answer. Duration is not the answer. Okay, duration is totally different concept. Okay. So what is it? Stress or downside? Stress or downside? The correct answer is yes. The correct answer is stress testing. Remember, just now I gave you this meaning of the stress. What has not happened up till now? That's what is the meaning of this word non-normal movement. What has not happened up till now can happen, and that is used in stress testing. So in stress testing, we use various scenarios now. Can this graph go up to this part or up to here? Can it go up to here? So what all scenarios can be there? That all scenarios are tested over here. Okay. So stress testing is the answer. And the last question for today. Which of the following techniques are covered by stress testing? Which techniques? By stress. Okay. Simple sensitivity, scenario, maximum loss and EVT, extreme value theory. 1 to 4 all, 2, 3 and 4, 1 and 4 only, 2 and 3 only. So which are covered over here? Think. Now the answer is simple. Stress testing covers simple sensitivity. Sensitivity means what? Fluctuations. Now these are means these we are having again deep meanings in it. Today I won't be able to explain you. It will take much time. Simple sensitivity, scenario, maximum loss and EVT. EVT is extreme value theory. Extreme value theory means what can be my maximum extreme losses. Maximum loss means what? What can be my means no profit and all losses. You had the similar concept of maximum loss in your JAIB. That was called as, there were total 11 concepts, right? Remember them? 11 concepts in your accounting. Matching concept, then historical concept, then your entity concept, right? Then dual accounting concept. And one of them over there was conservative concept. Conservative. That conservative concept means this. Okay? It means that. It means this. So one of the approaches over there was conservative concept. Okay? So that conservative concept is similar to that of this maximum loss theory. So what is the option over here? The option is correct. 1 to 4 all. So that was a YT series for you. Now before going, let me show you the batches. Join the batches immediately for CAIIB starting from 22nd March. Okay. So click on CAIIB online, go to Adda 24/7. I'll always suggest you to go through the app. In the app you are getting 1% extra using the coin systems. Click on the CAIIB, then you'll see this AIM batch. Okay. 22nd March starting. Click on this batch. You'll see the details. Look at this: ebooks, test series, live classes, recorded sessions, expert experienced faculty. So everything you are getting. Ebooks, click on this ebooks. You are getting subject wise. Click on this subject. You are getting chapter wise. Similarly, test. Click on this test. You are getting chapter wise. See this, subject wise. Click on this. You are getting chapter wise test. Okay. If once you go on clicking, you get chapter wise test. So such is the details of the test and the ebooks available. Okay. So join this immediately. And what is the discount? Look at the discount. Click on buy now. You'll see 80% off. Put the code Y432. Never forget this code Y432. That will give you 81% off. Okay. Click on Y432. Click on continue. You're getting 81% off. Look at this. Y432. Click on apply. Look at this. 80% off plus 1% using the app. Okay. So such is the huge discount you get. Join the AIM batch immediately. Also, you can join the Mahapack. In Mahapack, you are getting multiple batches per subject. Plus, right now you are having that offer. The offer is, see this Mahapack 2.0. You are having the offer right now of double validity. Means you buy for 6 months, you get it for 12 months plus 81%. Okay. Don't forget the code Y432. Click on apply. Say this 80% plus 1%